Good afternoon. Welcome to the TreasuryONE webinar where we discuss the Rand strength that we're currently seeing in the market and what's going to happen with the Rand. Is it the beginning of the strength or is it the end of the strength or where's the Rand heading from here? We want to welcome all our attendees today to this webinar. We also want to welcome George Glynos from ETM Analytics that's going to give us a little bit of background about what's happening in the currency space, and then afterwards you can post your questions on the side panel. We will get your questions afterwards, and then Andre Cilliers, myself, and George will discuss the questions. So without any further ado, we hand over to George to give us his view on the currency market.
Thank you, Wichard, and welcome to everybody. Great pleasure to be chatting to you guys again, and always enjoy talking about my favorite topic, which happens to be financial markets and the Rand and the way that they behave, or in this particular case, in many people's eyes, misbehave. But I think there's a lot that we can go through that will hopefully offer a little bit of perspective and insight for those that are finding the Rand's movements a little bit counterintuitive. So without wasting any further time, I'm just going to jump straight into the presentation. And as you can see from the title, we've called this a year of consequences. And I think for good reason. We've just come out of, or we're busy coming out of a pandemic, and I'm not referring to South Africa so much as I am the rest of the world. The pandemic has been a huge blow to most economies around the world, and unfortunately, at the moment, it's still in full swing. The data that we collect from the official sources show us that confirmed cases are still rising quite rapidly, have been rising. Just when we thought that things were going to improve dramatically, we've had the likes of India reaching fresh record levels in terms of confirmed cases. Rising above the 350,000 new infections per day mark, which sets a new record. It eclipses what we saw in America, and of course is of major concern because with a lag, we start to see the death rate starting to increase quite significantly. And that, of course, has placed everybody on high alert that there not only could be more mutations, but of course, with India being the sixth biggest economy in the world, and a very strong impact on that front is going to naturally affect demand for commodities. Maybe it will stall the recovery, the global economic recovery to some degree. So we are watching that with interest and hoping that we don't come across more new variants that can get through the defense that the vaccines are offering at the moment. But as you can see from the very top of that little red line, it has turned the corner. We're hoping that that's the start of a new trend lower, and that we follow the trajectory as reflected by that gray arrow. And if it does, I think we can formally start talking about the beginning of the end of this pandemic. I think it's still going to be with us for a little while, but at least if we can turn the corner and just start to get a grip on those levels of infections, then things are likely to improve. As we continue to vaccinate, I read this morning that Europe is looking to have 70% of their adult population vaccinated by the end of June. The UK is ahead of that, Israel is ahead of that, and in fact, I think the US is ahead of that. So by middle of June, most of your biggest economies around the world will have gone through the worst of this and are going to be looking at opening up wholesale. South Africa is a little behind the curve on that front, but we will still get to benefit from external demand as that starts to pick up. So let's roll forward into what demand is doing. And if one has a look at the leading indicators as produced by the OECD, and data from the World Bank, we see that there has been a material recovery that's underway. We think that recovery has further to go, and we expect that red line to rise all the way up to that 5% mark as a clear sign that the recovery is well and truly taking shape. We think that it's going to manifest more strongly in the second half of this year, although the second quarter's data that we've seen thus far is looking pretty promising. Much of the reason for the very, very strong expectation for H2, the second half of 2021, is not just a function of a natural recovery. It's also a function of the tremendous amount of stimulation that's been applied to the global economy on the part of the central banks as well as governments. So the central banks have added at least 8 trillion in terms of asset purchases to their balance sheets in just the course of the past year. You can almost double that, if not slightly more, add to that in the way of fiscal stimulus that's been applied as well. And on both those fronts, we haven't reached the end of it yet. It's not like the central banks are tapering or slowing down their asset purchases. And if we have a look at what the governments around the world are doing, they are still pushing hard on stimulating further. The Biden administration announced just yesterday that they were looking at adding a further 1.8 trillion to the stimulus pot in order to help the US economy recover. So we've had a very, very strong response function from the authorities, both on the monetary and the fiscal front, with the singular objective of trying to reflate the global economy through the production of a new business cycle. And I think that they are going to be successful. The data that we are seeing right now, we tend to monitor the dollar liquidity cycle as a good barometer for what the global business cycle is going to look like. And here we see an extremely strong rebound. So that red line has never risen faster than it has in the past year. And that has been very much a function of what the Federal Reserve has done in terms of its asset purchases. But interestingly, the Federal Reserve has also been accompanied by other central banks that have pushed equally hard. So we have seen unprecedented efforts on the part of the ECB, the Bank of England, Bank of Japan, People's Bank of China, Bank of Canada, Reserve Bank of Australia. All of them have jumped in and have done their own stimulation. All that to say that beyond just the asset purchases, there's also been a concerted effort to drive down bond yields, for a singular reason, and that has been to lower the cost of debt for these developed as well as emerging markets. So the interesting takeout from this particular chart is the way that emerging market yields have been suppressed. And the spread between emerging market yields and developed market yields has compressed, it has narrowed. And interestingly, the developed market average yields on the 2-year have even dipped into negative territory. So there has been a significant effort on the part of the central banks, not just to conduct quantitative easing and purchase assets, with which they build their balance sheets, but also to drive interest rates lower in the hope that they will ensure that that credit cycle, as reflected in the previous chart, gains the kind of traction that we're anticipating that it will. And if they get it right, I think we'll be in for a period of 3 to 5 years of very strong boom. And that's going to come about largely as a result of all of the stimulation. To give that to you in a little bit of greater perspective, giving you a breakdown of what the developed market interest rates are looking like on the 2-year, you can see just how many of them have gone negative or basically at zero. The only one that is slightly positive at this point is the United States. But with the level of quantitative easing being applied there is going to be a natural cap on how high those particular yields rise. The problem, of course, is that it creates massive imbalances. And those imbalances come in many different forms, and they're listed on the right-hand side of this chart. But principle of those is the price signals of financial assets get distorted. It becomes extremely difficult through that distortion to price adequately for risks. And as a result, banks are constrained in the degree to which they lend money out. Also, they will find it a lot more difficult to raise capital in a negative or almost zero yield environment. Furthermore, it incentivizes governments to borrow, and unfunded liabilities that sit on balance sheets of the big insurance companies overseas are growing all the time. So it's not without consequence, but it doesn't mean that we don't get to feel a massive credit cycle and a business cycle to boot. It also has the consequence of weighing quite heavily on the dollar. So if you understand the way that consumptive and investment dynamics work in relation to the currency, you will know that if consumption is boosted well beyond a natural level that would have arisen out of a prevailing economic environment, and if you consider that investments might be boosted significantly through a low interest rate environment, you'll also appreciate that demand for imports will therefore rise well beyond what a prevailing economic environment would call for. It means that your trade account swings very deeply into deficit territory, which the US trade deficit trade account has. And so recently we've notched up record trade deficits in America. That comes accompanied to a record or near record budget deficit. So the US is battling two deficits at the moment, very structural ones. The one is the trade deficit, the other one is the budget deficit. It implies that the dollar is likely to weaken through the course of time as a result of both of those. And as we dial down the degree of risk aversion and people feel a little more comfortable in heading back into emerging markets, so you're likely to find that the dollar itself it could very well lose ground. Looking at the dollar's valuation as reflected in this chart, you can see that recently, and if you just focus on the median of the valuation across all of those different currency pairs, which is the dark gray band, you will see that recently it in fact reached very high overvaluation levels, north of 25%. Historically, levels above 25% overvaluation have not been sustained. You can also see that there's a very clear cycle that has played out with respect to the dollar through the past few decades, and it looks and it appears for the time being that we have reached the top of this one, and that we could very well start to nudge lower through the course of the next few years, which in itself is obviously going to have an impact on the likes of the rand. Turning to the speculative element, just to corroborate that evidence, what we find is that speculators, reflected by the blue bars here on whether they are either bullish or bearish the dollar, above the zero line they are bullish, and below the zero line they are bearish. And the impact that it has on the trade-weighted dollar, which is the gray line, you can see very clearly that they have been quite bearish on the dollar, and it has dragged the dollar weaker. More recently, they have trimmed those bearish bets on the dollar, but we expect those bearish bets to start to ramp up higher now that we know that the authorities are going to leave interest rates fairly low or not fairly low, but very low for a prolonged period of time, and are going to continue with their quantitative easing. So all in all, what you find is an offshore environment that has bought South Africa time. Interestingly, it's done that through making South African yields look extremely attractive. Equally, through all the stimulation that's been applied internationally, we've seen demand for things like commodities. And South Africa being a commodity currency, or South Africa holding a commodity currency, it means that the rand could very well perform a little better than many other countries' currencies that aren't linked directly to commodities. The current account is therefore better positioned, and we've seen that in recent quarters. South Africa has produced some strong current account surpluses. And most of that, of course, has been driven by South Africa's very positive terms of trade. So the interesting takeout from this particular chart is that South Africa now ranks, or the rand now ranks, third from the top out of 22 countries. Of course, we ran this exact same framework across all of these different countries. So we are comparing like for like, apples for apples. And it's notable that the rand has risen so far up the rankings. When you have a look at it in terms of time series, you can see that South Africa, or the rand's carry attractiveness, which is the blue line, sits comfortably above both the emerging market average, which is the black line, and the developed market average, which is the red, and even moving in the opposite direction. So South Africa is clearly standing out at this point in time and performing quite well as a result. Another factor to take into consideration, of course, is also that the rand was deeply undervalued in around April last year when it fell out of bed in response to the deep lockdowns that took place and the huge amount of market distress that took place shortly after the lockdowns were announced. So if you recall, rand rose to the 19 rand to the dollar mark. It has since staged a fairly significant recovery and come back a good 20-odd%. So from there, where we were more than 30% undervalued, we're now just a little more than 10% undervalued. It tells us that there is still room on a nominal level for the rand to stage a recovery back to fair value. Of course, against that, we do need to take into consideration some of the risk factors that are inherent with South Africa and the rand. And the most notable one of those is, of course, what we're seeing on the fiscal front. South Africa's fiscal slippage has been fairly pronounced over the past couple of years, but it has been in place for the better part of a decade now. And so that's starting to catch up to the country. And of course, we've got to appreciate that there will be a discount that is required for foreign investors to invest into South Africa, and that may very well assist in keeping the rand undervalued for a little while longer. All that to say, though, that there is still room for the rand to recover further. One of the indicators that has also alluded to the rand's potential recovery has been the rand sentiment indicator. That is your dark blue line. The lighter gray line in the background is the higher frequency version of the blue line, which is the indicator. It gives us a sense of the path dependency that the rand might follow. So the year-on-year growth in the rand is reflected by the black line. In essence, the higher the blue line goes, the greater the probability that the rand might recover. The lower it goes, the greater the probability that it will lose ground. Now, interestingly, the rand has staged a very, very strong recovery. It has followed the path that the rand sentiment indicator was alluding to, but as you can quite clearly see from this chart, that we are now starting to run into the end of that move. The rand sentiment indicator tells us that there's probably we are probably reaching fairly stretched levels right now. And that we shouldn't bank on the rand strengthening at another 1 to 2 rand from here, but it could still strengthen back below 14 rand to the dollar before it stabilizes and forms a base of which we could see some rand depreciation later on this year. One of the fundamental differences in the way that the rand has recovered this time around has actually been the way that the real economy has interacted with the balance of payments, and that has been predominantly through the trade account. So if you have a look at the chart on the left, reflects the trade account, and you can see how strongly in surplus that trade account went. In fact, those were record trade surpluses. We've listed it as a % of GDP and smoothed it, but the point remains exactly the same, that the trade account has swung very, very strongly into a very large surplus. And the combination of that, or the main driver of that, has been what we see in the right-hand chart, and that has been the improvement in South Africa's terms of trade. So if you have a look at South Africa's terms of trade, you see that we are now at the highest levels since 2011. That is reflected by the blue line. The red line, of course, is the dollar rand. As that blue line rises higher, so you get a sense that the dollar rand may very well improve still further through the months ahead. Just a quick note of caution when you look at this, that red line reflects to the right-hand axis, which is the inverted scale of the dollar rand. And so the higher the red line goes, it means the stronger the rand becomes. A further point to note is that importer demand has also been particularly weak. The trade account has been the strong, not just because our exports have been good, but also because our imports have been particularly weak. It's a function of an economy that's been struggling. The left-hand chart gives us a sense of household personal consumption expenditure, and you can see across durables, and non-durables, there's been a big dip off. Total private consumption expenditure did exactly the same thing. And just at that point is when you see that the trade account, which is reflected by the light brown line, swung very strongly into surplus territory. Look at the chart on the right-hand side, and you see gross fixed capital formation. Another word to say that is fixed investment has been trading below the zero bound now for a few years. And if anything, that blue line has been trending lower, off a low base. So the level of fixed investment in South Africa has been poor. The level of consumption in this country has been poor. And so you get the picture. Imports cratered, exports did quite well. The trade account swung very strongly into surplus territory. It has played a material role in helping the balance of forces move in the rand's favor. Over the longer term, the picture is less rosy. So whilst we can build an argument for why the rand should be strong or even strengthen a little bit further in the short term, we know that the longer term picture is not quite so rosy. The biggest problem here, of course, has to do with politics. ETM conducts a composite scorecard where we have a look at a number of underlying subcomponents that give us a sense of how the economy is working. We combine those into an index. We adjust it for the business cycle, which is effectively the blue line. And so we get to score the different administrations on their general performance. You can see quite clearly that the Ramaphosa administration has not done particularly well, but we would have to point out that much of that is a function of an overhang or a huge hangover from the Zuma era. So the Zuma era doesn't look quite as bad, not because it wasn't as bad, but because the full effects of it hadn't been realized yet. Some of those full effects have only been realized through the Ramaphosa era. They are trying, or Ramaphosa's administration is trying to turn this around, but I think they've got their work cut out for them. They are faced with a very deep fiscal problem. And that fiscal problem is very much a function of tax revenues having dropped off very, very sharply. What you're looking at here is a ratio of tax revenues versus money supply. Those tax revenues versus money supply dropped off very sharply. There's been a little bit of recovery, but they're still well down in terms of where we were pre-COVID. And that places government's finances under enormous pressure. And there's some serious question marks about whether or not we are going to be able to normalize this to the degree that the fiscal authorities would want. What we find is that we've just recently produced a record budget deficit, as reflected in the chart on the left. To give you a sense of how far we've got to go, well, we've got to unwind shortfalls of approximately 500 to 600 billion rand through the course of the next couple of years. Should we not do so, what we will find is that the chart on the right reflects that our debt levels will continue to rise towards the 90% mark over the next 2 to 3 years. And that has a very material impact, not just on South Africa's ratings, but on South Africa's risk profile. The trajectory, as you can quite clearly see, has been rising for some time, accelerating over the past couple of years. The idea that we are going to suddenly flatten that trajectory now is a little bit hopeful, one would say, to the extent that they are. We hope that it proves accurate. We're hoping that the very strong growth that will be produced from abroad does spill over into South Africa, and if it does, some of these trajectories, as you see here, the latest one being the green one, might indeed be possible. But while they're busy trying to do that, it is also worth paying attention to the fact that South Africa's debt service costs have been rising. It's the fastest growing line item in the budget. And so South Africa is now ranking quite poorly in the rankings of average debt service costs as a percent of revenue. Just a few years ago, we were sitting around mid-table. We have dropped further down the scales right now and rapidly approaching those countries that have been more delinquent in the way that they have managed their fiscal position. And so that is a little bit disturbing when you're running such huge budget deficits against the backdrop of interest rates that are nearing double digits in the middle to longer end of the yield curve. That makes it a lot harder for a country to finance itself. It's also the reason why South Africa's fiscal resilience score has fallen as sharply as it has. And out of 22 countries over which we ran the exact same framework, the fiscal resilience score scores very poorly, just 1 out of 10, which is effectively the blue bar, and that ranks at 21st out of 22 countries. So it effectively tells us that the susceptibility to another shock is extremely high. There simply aren't any resources to tap into in order to help the country through another crisis. Reflected in time series, you can see quite clearly that the fiscal risk, which is the red line, is where we are falling short by the greatest amount. The underperformance of the economy has also forced the Reserve Bank to cut interest rates quite aggressively, more aggressively than it would ordinarily do. And so its monetary rectitude score has also fallen from a fairly impressive 7.5 out of 10 all the way down to under 3 out of 10. Now, I can tell you that at 7.5 out of 10, our monetary rectitude ranked as one of the very best in the world. In stark contrast to what we were seeing on the fiscal front, which ranked as one of the worst in the world. So the net result of that is that the overall resilience score, which is the dotted blue line, has dropped. We now rank just 2 out of 10, which is incredibly disappointing because it places us at the very bottom of the rung in terms of these resilience inputs, or in terms of this resilience framework. So it tells us a story, and the story is one where in the short term, it's quite possible for the rand to do well, or perhaps even improve a little bit from current levels. Certainly going back below 14 Rand to the dollar is possible in the short term, but we do not believe that over the next 6 to 9 months, those levels will be sustained. In fact, quite the opposite, as the effects of South Africa's fiscal position become clearer through the course of time, and we expect to see that more towards the back end of this year, going into 2022 ahead of the next budget. So we'll start to see that risk premium being passed into the rand increasing a little bit further. So Wichard and team, I think that's it from my side for now. I would be very happy to take any questions, but I think the view is clear. Short-term rand strength and resilience will gradually give way to some stability before we start to migrate weaker again over the medium to longer term, and the primary reason for that is going to be South Africa's fiscal position, which has steadily deteriorated through time.
Thanks so much for your insights, George. We've got 1 or 2 questions. Obviously, the first question starts off, I'm just reading here, is about the COVID situation and the lack of vaccinations from South Africa's front. Do you think that will play a role as the rest of the world rolls out vaccinations and South Africa lags behind? And will that have an impact on the currency going forward?
So, look, it's an interesting one. We do know that South Africa's numbers at the moment are looking actually quite good. South Africa's COVID numbers are amongst the lowest in the world. For all the talk about the South African variant and how aggressive it's been, in fact, our numbers are looking pretty good. So at this point, we don't think that it has a huge impact just yet. The South African economy, if one has a look at the mobility statistics, is largely open and functional. It's safe for having to wear masks, and parts of the entertainment industry, which are still not operating at full capacity. The South African economy is largely open. I think we do get to benefit, obviously, if vaccinations do come through and more restrictions get lifted on South Africa. For example, we're still on the red list when it comes to the UK, so traveling there is a little bit difficult. Of course, we know that the lifting of restrictions will also boost confidence and growth dynamics as well. So from that perspective, I would say South Africa at this point is still okay, but we would be hoping for those vaccinations to come through. If they don't come through and we experience another wave, of course, that is going to throw the cat amongst the pigeons, and everything that we've been talking about might be accelerated forward. In other words, that phase of rand weakness we might encounter it a little earlier this year. So we hope that the authorities get their act together and that we do vaccinate. An interesting bit of information was received earlier this year when they did some analysis on the blood banks in the country, and they found that 63% of the bloods that they had tested already showed high degrees of immunity. In other words, they had already caught COVID, recovered from COVID, and there was inherent immunity in those in those blood samples. It tells us that South Africa may have already reached something approaching herd immunity, which would go quite a long way to explaining why our numbers have fallen as sharply as they have, because aside from that, it becomes extremely difficult to understand how South Africa's numbers are as low as they are.
Then another question that comes in here is about the oil price and what's going to happen with oil down the line, and the petrol price being at record prices. Will that have an impact on the currency? Andre, do you have any comments on that?
Well, I've listened to George and I've looked at the figures, and the decline in imports and the oil price is very much part of that, because during the height of the pandemic, we must remember that South Africa, being a very big oil importer, because we don't have any oil, during the low prices of the oil reached after the pandemic struck us and the lockdowns throughout the world, the value of imports also declined significantly. Now, since then, with the recoveries that's taken place, we've seen the oil price going up, and we've traded at one stage slightly above the 70, now around the mid-60s. And if you ask my opinion, then I think we will remain within these ranges of between 60 and 70. I doubt whether we'll breach the 70 very easily, unless we have fantastic news coming out of the world and seeing the world returning to growth and the whole pandemic sort of subsiding even more. So that bodes well. We have seen the fuel price increase quite significantly at the beginning of April, but that was partly also because of the added taxes and everything, and it was during the month that the oil price had reached those 70 levels. As for this month, I think we'll flatten out during April, and we will not see too many further increases. So for a consumer, that kind of bodes well. And yes, I think we'll return to a little bit more stability on that end.
Anything to add to that, George, or happy?
Yeah, I mean, oil prices have been notoriously volatile historically, and they are a huge factor, as Andre alluded to. I mean, they're South Africa's biggest import, so it makes a very big difference to the trade account. Quite frankly, if oil prices shoot up back towards 80, 90 a barrel, that hurts South Africa. It takes that chart of the terms of trade, and it turns it lower very, very quickly. And of course, then one of the big tailwinds that the rand has enjoyed over the past couple of months dissipates. So the oil price is definitely something to watch. Global growth is equally something to watch, because it not only has an impact on oil prices, but it has an impact on commodity prices, which South Africa, of course, exports. So when we have a look at things like PGMs and gold and whatever else, that does play a significant role in boosting the terms of trade. So I think what I'm saying is the oil price is part of a broader picture of growth, and that growth dynamic and how it ultimately plays out in demand for commodities. Yeah, I mean, I hope Andre is right with his views on oil, because if they are, then South Africa's terms of trade get to hold on, and South Africa gets a rand that remains resilient for a little bit longer than, another 1 or 2 months, and perhaps that resilience can last more like 6 months. But we can see early signs that the risks and the balance of pressures are starting to shift a little bit against the rand as we start to progress towards the end of the year. And you've got a couple of risk events that we need to watch out for. In October, we've got the medium-term budget. In February next year, we've got the main budget. Given that fiscal is South Africa's biggest problem at the moment, those two might feature quite prominently on the risk radar, if you like, for what might drive rand.
So you've touched on medium-term budget. One of the questions just came in here as well, is both yourself and Andre has been very vocal about the budget slippage, and the economists and the budget in February gave everybody praise about the good budget that Mr. Mboweni delivered, and that was because of the windfall of the extra tax revenues. So with medium-term budget coming up in October, and you alluded to fiscal being under pressure, and South Africa's growth that everybody's still projecting to be well below par with the rest of the recovery of the world. How do you think South Africa is going to get out of the fiscal trap? We're seeing that there's a lot of strikes also coming up in the public sector. Will that have an impact on the currency at all?
Well, Wichard, I'd like to sort of go first before George cuts in here. When you look at spending, when you look at any budget, and let's take it back home, to your own personal budget. If you don't cut your expenditure, there's no ways that you're going to get to lower your deficit, your shortfall. If you're spending more than you're earning, you're in trouble. Then your graph runs upwards, and George had showed that to us. If you look at the last couple of years, our deficit has just grown. If you look at our borrowing as a percentage of our GDP, it had just grown. Yes, on his graphs, there was this forecast during the medium-term budget speech of 2020 with a line slightly below that for the budget that was read to us in 2021, and that made people optimistic. Now, when I see a line going up, it tells me that I'm still borrowing more to fund my expenses. That doesn't make me happy. And if you look at your personal side, as I said, you spend more than you earn, liquidation and sequestration is eventually what will happen to you. And that is exactly what a fiscal cliff means. And that's unfortunately the way things are going. Short term, Mr. Mboweni might get some luck with commodity prices being very high. We might see a little bit more taxes coming in, with banks having written down debts and made big provisions last year, and things looking a little bit this year. They might, write back some of that provisions, and their profits might be a little bigger. So very short term, he could get some money, but he's still got the problem of a heck of a big workforce that works for the government that wants more money. And the demands coming from that side is immense. It's not small. And they say if they don't get the money, then they'll strike. So Mr. Mboweni still have massive, massive problems. I would suggest that he starts looking at selling some of the assets that is most probably still sellable, because the way things are going, he's going to start running out of having sellable assets as well. So in that I refer to as privatization. So he's going to start looking at that, getting money back, and then repay debt to make that 22% of every cent of every rand that we get and pay off on debt, bring that back down to 15%. So I'm not optimistic about how these things spell out. And as George rightly then said, 9 to 12 months from now, we will be bitten by that.
Yeah, so then one of the last questions that we're going to attend to is South Africa's terms of trade are still good, and that's because of, like alluded to, a lot of the commodity exporters that's coming up and very poor demand in South Africa. The fact that the US is still continuing printing money flat out, like there's no tomorrow, that's propping up, well, cryptocurrencies out there, the equity markets out there, people seeking yield coming to South Africa, that's obviously helped the rand. So if we see the rand weakening towards the end of the year, do we talk about 16, 17 rands, or do we got to lower realizations and say, if we see weakness in the rand, we're only going to see it to 15.30? Asking the question on behalf of someone. So what's your views on that?
Lower your expectations. 16.50 is not.
I think, yeah, I mean, it's as Andre has alluded to. I mean, we are fearful of the impact of fiscal longer term. Getting the timing right on when rand is going to begin its big depreciative move is always going to be difficult. But I think the path has already been set. It's just a question of whether or not they can reverse it. And at this point, as Andre mentioned, it doesn't look like it. So even though you've got the Fed that's printing, like you mentioned, Wichard, and the dollar is being debased and crypto is surging, and equity markets are rocking and rolling from record to record and reducing overall levels of risk aversion, you might still very well find that rand weakens despite all of that. Don't look at what's happening at the moment. At the moment, the rand is behaving very strongly, and rightfully so, but it doesn't need to remain that way. The risks against the rand are rising. I mean, I did a little study. I've been doing a little study on the current account. Literally the only part of the current account that is in surplus at the moment is the trade. So it's trade in goods and services. Every other subcomponent of the current account is in deficit. And so that gives you a sense of when that trade account eventually reverses and moves in the opposite direction. The tailwinds that have helped the rand so far dissipate very, very quickly. And so I think we've always got to keep that in mind. So like in terms of picking specific levels, I mean, if you're asking me whether levels of 16 and 17 this year are possible, well, you know, deliver a very poor medium-term budget, and absolutely they're possible. Restore some confidence in the fiscal outlook by just delivering something sensible in terms of the medium-term budget, and no, then I would say, you know, Andre's view of you know, 16 and 17 being too high is probably spot on. All I do know, and I'm going to leave the penciling in of specific levels to Andre, but all I do know is that I don't believe that the current phase of rand appreciation is going to be with us for particularly long. So importers should take advantage of these levels. I think exporters are going to get better levels in time. If they haven't covered up until now, they've kind of missed the boat a little bit. But it'll come back to them in time, because, quite frankly, I don't see enough from the fiscal authorities to turn this thing around. Andre's mentioned the negotiations that are taking place at the moment on the wage front. it's just not looking particularly good. And until such time as they get to stabilize things, your medium to longer term outlook for Rand is always going to be tilted probably more in favor of Rand weakness than Rand strength.
So if you look at levels, Wichard, then, levels is always an extremely difficult one. I'm saying 16, 17, lower your expectations, because I think that is really, really an off chance that we will see levels of that this year. But you can never say never. Anything can happen. But when you start looking at taking forward cover and managing your risk, there's products that can be used to both get upside potential and cover your risk on the downside. So it would be specific to every customer. It would be specific to every person taking forward cover as to what they're allowed, what they're not allowed, what the policy says. But, to sit back and say that I'm going to do nothing and hope that I get 16 or 1650 would be a bit of a cowboy attitude, in my opinion. And there's better ways of managing your risk. But as I say, that would be specific to every customer. It would be specific to the time flows, the time periods. There is still, in terms of the yield curves and interest rate differentials, there's still quite a bit of forward points to be taken off the table if you take forward cover that gets added to your spot and gives you an ultimate better forward rate. But I would just suggest that people get in contact with us so that the portfolios can be looked at and discussed and decide what's best in their best interest and the best product choice for them.
Thanks so much. So yeah, in a nutshell, in the short term, we can probably still see the Rand strengthen, and 1380s and 1375s is a possibility. Some longer term weakness is what we're expecting in the Rand, but not expecting too much weakness. So a 14 to 15 range probably looks like the outset for the year. We just want to thank everybody for joining the webinar, and thanks to George for presenting a very insightful presentation, and Andre joining in some of the discussion questions. Thank you so much for your time, gentlemen.
Great pleasure, everybody. Thanks for the opportunity, and best of luck to everybody out there.
Thank you. Likewise. Thank you. Bye.